What in the world of volatility just happened in the global market? Tom Lee is calling it just a growth scare, with statistics of why the same rule is no longer accurate after the COVID-19 2020 recession. And plus, what the yen carry trade is explained a little bit more in depth. Here's a video of Tom Lee explaining what happened in the market and what's next to come in the future.
So let's ask Tom Lee. He joins us now live. Welcome. It's good to see you.
Great to see you, Scott.
So I look at your notes today, and you suggest the worst is behind us. What makes you think that?
Well, I think the thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind. But I think the worst of the selling pressure is behind us.
How do we know that we had just a growth scare and not something more dramatic to come, Tom? Never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday. And a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds. And next Thursday, they'll get another weekly claims number. And if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well offsides, and it just needed to correct itself. Has it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive, because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that has been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah. What do you make of how this week began? Not with necessarily the market upset, but the commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do a 75 basis point cut in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Sana at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got your back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid. But to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
Can you tell us what happened earlier this week? What is the event on Sunday and into Monday?
Well, Ryan, that's a great question. I think that we'll probably never know the true reasons, but I would say the things that are high on the suspect list are two things that happened starting last week. One was, I think, sort of the most immediate trigger was the Friday jobs report, which was the employment report for the U.S. for the month of July. And that showed a pronounced weakening of hirings. There were only 114,000 jobs added. That was really one of the first big misses since the start of the pandemic. And I think it really fueled fears for investors that two things were underway. One was there's this rule called the Somm rule that Claudius Somm wrote, which is if unemployment picks up 50 basis points, you're already in a recession. And that report showed unemployment had picked up 50.5% from the lows. And the second was that the Federal Reserve had a chance to cut rates just 2 days earlier that they didn't. So now the market sort of panicked because they're like, well, the Fed can't really do anything until September. And it put downside pressure on markets. That was, I think, the first trigger. The second trigger, which might actually have a trigger to the trigger, but the second trigger was that same week, the Bank of Japan raised their overnight rates by 15 basis points. It really was slightly positive already, but it went to 0.25%, which for Japan's the highest overnight rates since the financial crisis. And that triggered what looked like to be a reversal of a lot of what they call carry trades because the yen weakened further. The yen started to rally. Yen had been weak, but it had been rallying, and that was making the carry trade, which is you borrow yen and then you buy other currencies, look unattractive. The only reason I'm not sure if these are the triggers is, you never know. And I know some of my colleagues at Fundstrat have actually pointed out that the intervention, there could have also been intervention by the Bank of Japan on currencies because that started on July 12th. That's really when the yen began to weaken. To strengthen. I get these conversions mixed up. And the reason is that at 160 conversion, that sort of offsets the benefits of weaker currency on exports versus the inflationary pressures. And so, it was really on that date that the yen started to rally. So sorry for the long explanation. We really won't know, but there was a lot of panic and deleveraging that took place.
Okay, a lot of panic on the back of recession fears due to unemployment numbers on Friday, and then this yen carry trade, which people are talking about. There's also talk about maybe the conflict in the Middle East and something heating up there that's kind of unknown. Kamala Harris White House, sort of the market may be reacting to that and saying, well, maybe it's not as favorable if the Democrats win the White House again. AI just being incredibly frothy this year, could it have been one of those things as well?
Yeah, I mean, those are all valid contributing factors too. Yeah. And as you know, when it comes to war, markets don't like the buildup, so they always say you sell the buildup, you buy the invasion. So we'll have an idea of how markets really feel once the retaliation starts.
Okay, so can I get some context on how bad this actually was? I saw this chart of the VIX, right? And you see these lines going up on the VIX in 2008, it goes crazy, and then COVID 2020, and then this event on Sunday and into Monday. And it looks spiky. And of course, 2008 was world changing, and as was COVID. And this had a similar kind of like effect on the market. And indeed, I haven't seen a down day on crypto on a weekend of like 20% plus in quite a long time. And crypto kind of reverberates some of this as well. But like, how bad was this? And what's the likelihood that we get some aftershocks, after booms, that this continues?
I mean, it was pretty bad. I think you kind of highlighted one of the best measures for it, which is the VIX, the spot index, and it hit 60. And again, it's not clear why the VIX hit that level. There's many reasons it spikes. I mean, it's basically the expected volatility in markets, and it did soar. Is it because the carry trade was already short vol, so that's why they had to cover, and that's why it spiked? Or is it the longs were trapped over the last few days, especially over the weekend, and one way to protect is to go is through the VIX, is through trading volatility? Or is it just the market was so uncertain that that's what happened? Because that's what happens in panics. In fact, the skewness of the puts versus calls actually went to minus 25. And again, that is a pretty rare reading. It happens usually near the end of a panic. So I think there was definitely a lot of panic, a lot of margin calls, as you can imagine. So I think margin clerks were really busy yesterday. And I think a lot of that dust is settling today. But it does sound like a lot of it was retail liquidations. I think high net worth and institutions were actually buying yesterday.
Okay. Do you think there's anything to maybe uncover at some point in time? Do you think any like major funds got sort of wiped out? I mean, we're watching this in crypto, and Jump Crypto was just sell on a lot of their crypto assets. That's not definitive proof of what's going on, but like obviously when this sort of cascading high volatility days happen in crypto to the downside, people get liquidated, and it can get pretty ugly out there. Do you think some of that will we'll see evidence for that in the days and weeks to come?
Yeah, I mean, I wouldn't be surprised. The jump, which happened over the weekend, was really stood out. And as you know, short volatility was a crowded trade. So anyone being caught short volatility on a spike to 60, I mean, that is deadly. Last year, on a smaller spike in volatility, especially across rates, had already triggered the failure of a very large multi-billion-dollar hedge fund in the U.S. And I don't really want to name that fund, but viewers can sort of look back. And so I wouldn't be surprised if there's a couple of failures, and it'll be revealed in coming days.
Okay, well, maybe there's a binary here. It's either over, that was sort of a Sunday blip, and then we sort of resume the bull market that we've been in, or it's not over, and there are worse things to come, and like more dips and more volatility, etc. What's maybe the case for each, and where do you fall on that argument?
I mean, we're in the camp that this was a growth scare. And, if the trigger was either the jobs report Friday or even this carry trade unwind, those are temporary effects anyways for markets. To be concerned, it's a larger effect. One has to believe that a recession is already starting, so that the Fed can't act to contain the ripple effects, or that financial conditions tightened in a way that require more intervention, and that essentially dilutes the ability for stocks to recover. And as you know, yesterday, and I think a lot of people talked about it, the carnage was primarily in the equity markets. Credit was actually really well behaved, whether you looked at triple C or high yield or spreads or bond volatility. There's a VIX for the for long bonds, VXTLT. All of those were relatively behaved. So this really did look a lot like an equity panic. And there is a rule of thumb that we used to use at JP Morgan, which is that bonds lead stocks. So when stocks diverge like this and there's panic, it's not
it shows you people were trying to get liquidity. They weren't necessarily responding to something had changed. And so if the selling frenzy is over, the recovery should be pretty sharp for risk assets. Knowing, of course, that we're in August.
Right, exactly. So let's say it was a growth scare. Then what's kind of your base case assumption? Does it take a while to heal from this? Do we sort of resume the same trajectory that we've been on? Do things change a little bit?
Well, there's kind of a scarcity or paucity of labor-related data in the next month because you don't get another real jobs report until August, first week of August. Sorry, first week of September for the August jobs report. So that's a month away. But as you know, yesterday, the ISM services had an employment component, and that actually showed a recovery. And on Friday, a lot of economists, including our own team, pointed out that there were so many things that made it look like Hurricane Beryl probably affected the jobs report for July. You know, Texas is vulnerable to heat already because when it's hot, you have to slow down a lot of activity. And in Texas, jobless claims rose 20,000 in a month. And there was almost a record number of people either employed and not working due to heat, or turned to part-time because of weather for both cases. And it was like 1 million in one category and 400,000 other, and both were like 6 sigma changes for that reported category in the household survey. So I don't know. I mean, the only thing is it's incongruent, because jobless claims aren't really consistent with a huge downturn in labor market. And a lot of it is Texas, the jump in claims, because ex-Texas jobless claims have actually for the last 4 weeks been pretty flat. And 1 million people lost power in Texas for 2 weeks. So you could see the knock-on effects on the economy from that. So I would say I think it's a growth scare.
Okay, so you think it's a growth scare, and your eyes are really on this indicator of the next jobs report that happens in September, and this should tell us whether we are creeping closer to, like using the R word, recession, or whether we've been in one, or whether we're like we resume the growth trajectory. And like, let's say jobs numbers
I
coming
want to make something
good.
clear. Interestingly, so if you look at the SOM rule,
Yeah,
which is that 50 basis point rise in unemployment rate. Since I'm going to pull it up here. Do you know that since 1949, that rule's been triggered 12 times? Okay. And 10 of the 12 times, you are already 1 quarter or 2 quarters into a recession. 2 times a recession was delayed. One was 1959, and the second time is it was triggered in July 2003. And the next recession wasn't until 2007. So the SOM rule, the reason, and Claudia Somm herself has disavowed it actually publicly in many appearances in the last 4 days, is that you'd already be in a recession. She made this rule because she wanted a simplified way to be ahead of the NVDIA, and she's basically saying it's not working because COVID kind of screwed up a lot of the metrics. So unless we're already in a recession, it's a bad signal. And actually, some weird math, but if you look at forward stock returns from the time the SOM rules triggered, since the Greenspan era, the 3-month gain is 8% for the S&P. So you'd already be like in a recession, like if it's triggered. So it's actually been a terrible tactical timing tool for stocks.
Okay, so let's say we're not in a recession, jobs numbers come in like reasonably strong in September, then what happens?
Well, the Fed starts cutting, but the Fed, I think, again, sorry, I'm speaking sort of propositionally because I don't know the Fed. Nobody knows what the Fed's going to do. So I think if we're talking about September, I'm just sort of being theoretical.
Sure.
But I think that they've committed to cutting, and the labor market has softened. It's just that it's not recessionary. So they would be compelled to take action. And so it's either 25 or 50. But one variation now of the Fed's reaction function is, as you know, they've been data dependent. And that's been a big criticism of markets because you're by nature always going to be late. And I think there's a real call now for the Fed to essentially become forward looking. I think that's the big change. In fact, Austin Goolsbee yesterday on CNBC, I don't know if you heard his interview, but he actually used the word forward looking when it comes to responding to financial stability. That is, I kind of would say that's an important word to keep in mind, that markets have been frustrated with a data dependent Fed. And so I think come September, even if it's 25, but they say that they're going to start being more forward looking, especially regarding inflation. I think that, they could do 5 cuts this year.
And say that happens, then what do we get?
Well, something to keep in mind is that if the Fed is doing 5 cuts and their dot plot was 3, that's a incrementally dovish Fed. And so I think that is indirectly going to be interpreted by markets as a Fed put back into play, like put for the economy. But now the economy is the stock market and risk assets like crypto. But there's a practical effect. Auto loans, small business loans, which used to use LIBOR, but they don't. They use a SOFR now. Credit card debt, home equity lines of credit, adjustable rate mortgages. ARMs are becoming very popular because of the high cost of fixed rate mortgages. Those will see huge drops if the Fed cuts 1.25 percentage points. So there is a true economic catalyst. I mean, if someone says the Fed cutting doesn't going to make a difference, I mean, this is an economy that's been crippled by high cost, and then you're taking that high cost away. That really would revive demand, at a time when the consumer still has a lot of room to borrow money, actually.
Do you have any worry that any cuts by the Fed might amplify the carry trade risk that we've seen with the yen, sort of, a stronger dollar type of effect, and just like make things work, make the things that we saw on Sunday even worse?
Well, yeah, that's a good question. I mean, the Fed doesn't want financial instability, but, a stock market going up 20% isn't really concerning the Fed. What concerns them is a misallocation of capital. And if capital is put into financial markets because no one wants to do CapEx, or nobody wants to expand a business because the Fed might crush the economy, we might have to think that by cutting interest rates, the Fed is essentially allowing capital to be put back into the real economy. I don't know a lot of CEOs who've been doing CapEx, because why would they invest more at a time when the Fed's tight and is worried about inflation and could crush the economy? I mean, that's not the kind of environment that greenlights capital spending projects. So I think, believe it or not, it's actually has been an impediment to economic growth, but it also has amplified carry trade, because you're right, people seek yield when you have an artificial high cost of money.
Tom, can you make the steelman the argument for that this wasn't a growth scare, that we are maybe in the beginning of a recessionary period of time, that things get more bearish from here? If you were asked to kind of steelman that case, what would you say?
Okay, so let's flip the hat. I would say, you know what? A recession is, expansions don't die of old age. They get killed by the Fed, right? So, so did the Fed stay tight too long, and it's already killed the economy? Well, that's one way you kill an expansion. The second way, of course, is you create a shock. I mean, let's look at both, but is the economy already in a path to actually crumble? The area that's weak right now, we already know there's 3 areas of recession. Auto sales is in a recession. Whether it's used car prices are going to on a free fall. Tomorrow we get Manheim, but used car prices have been tanking, and automakers raised prices with greedflation. Now there's inventory piling up. Auto delinquencies are up. That's in pretty bad shape. The second area that's in bad shape is durable goods. I mean, people aren't buying appliances, things that installment debt. I mean, it's just too expensive. Credit card debt is, cost of credit is 25%. I mean, who's going to buy a dishwasher with those kind of costs? And the third is that housing activity is in a recession because it's prohibitively expensive to get a mortgage now. And home prices have gone up. It's not clear if they're going up because of tight supply or if it's, for whatever reason, but it's gone up. And it's hard to get money. So could those three drive a recession? Absolutely. I mean, a durables recession and housing is really sometimes where you get a recession. So is housing so far gone that is impossible to turn around by the Fed? We'll see, right? I mean, if they're worried about inflation, they could put a death spiral in that part of the economy. There's not over investment anywhere else. I mean, the stock market, like let's say someone thinks it's a bubble, it's not really what causes the recession. It's that too much capital is raised in a bubble and then it's misallocated. That's what happened with the .com. And then of course there could be a shock. I mean, like what you're pointing out, is the yen carry unwind, is that a shock? I mean, that could be a shock. Is if oil supply is massively disrupted, that definitely could be a shock, right? I mean, oil could go either way. It's either going to go up a lot or down a lot, but that could create a shock too. And that could just, and that could interrupt trading of currencies. I mean, currency stability is important too. So I think it's possible that you could have a recession, but really, like as I talk it through, I would say the housing thing, I'm not as inclined to think it's going to lead to a recession because we know there's a lot of pent-up demand. It's not like you've exhausted demand, and mortgage rates will drop as soon as the Fed starts cutting, especially adjustable rate. But could oil spike? You have to get oil to around 250, and around 250, the debts, the cost of gasoline as a percentage of household income is enough to be recessionary.
Have we ever Have we ever seen a growth scare like this in the past, Tom, that would be analogous? Because, like just looking at the VIX, we see, 2008, 2020, and obviously a lot more happened after the initial VIX spike. A lot of negative things, right? And it just seems weird that the market, like the whole thing feels weird. It feels weird that the market is so on edge, so fragile, like just a little blip and then boom. The Japanese stock market is down 12%. And like it feels like we're in a sort of a strange time. And it may be getting back to kind of the .com bubble, right? AI has been on an absolute tear. That could be in bubbly territory. But like just in general, is there anything like this that we have seen in history that would be analogous?
Ryan, I want to just point out a couple things. I'm not trying to oversimplify this, but because I've been following equity markets for 31 years, 32 years actually now.
That's approximately three crypto lifetimes, I would say.
Yes, that's right. I'm like, then yeah, that means I'd have great grand crypto children.
Yes.
They say bull markets take the escalator up and the elevator down. So big corrections like this are more associated with a bull market than a bear market.
Now let's explain the yen carry trade. And this is from a creator on Twitter named Travis Holm, who gave a really great example of how it works. So you take a loan in a currency that has low interest rates, such as the yen, convert it to US dollar. You then invest it into a T-bill or government bond at 5%, leaving you with a difference of 4%, with a net profit of $276,000. Here's an example of how you lose money in a trade. Let's just say the exchange rate goes down 10%. Here's the original one with the higher exchange rate. Another way to lose money is when the value of the US asset invested in goes down in price. Here's another example. If the yen interest rate rises from 1 to 3%, it's going to leave you with a net loss of $138,000. I hope this was able to give you a quick view on how the yen and carry trade works and what was behind the whole chaos that went on in the stock market. Make sure to do your research before you invest in any financial instrument. Don't forget to subscribe to the channel and click on the link below for some free stocks from Moomoo and Webull. And thank you for tuning in, and see you next time.